Imagine your $1 million portfolio losing over 25% within weeks of retiring, and then having to watch it decline even more as you sell assets so that you can live. 1 year in, and your starting value of $1 million is already down to 700,000. Yikes. Apologies for the scary beginning, as Halloween was a few weeks ago, but this is not just a story to scare you straight. It's within the range of reasonable outcomes that we may actually face and therefore should plan against. So, if you're interested in turning this nightmare scenario into one that allows you to go back to sleep, subscribe to the channel, hit that like button, and join me today as I discuss sequence of returns risk right here in the red zone. The phenomenon of an initial poor sequence of returns or sequence of return risk is why the period just before and after retirement have been dubbed the red zone. We often think about sequence risk in terms of once we are retired. So here's an example from Charles Schwab. Both retirees depicted start with $1 million and withdraw 50,000 annually and plan to adjust 2% per year for inflation. Investor 1, indicated in purple, sees a 15% decline in the first 2 years of retirement and then averages 6% afterward. Investor 2, in yellow, sees the opposite, 6% gains and then a 15% decline in years 10 and 11. Notice the difference in balances. Our purple investor runs out of money in year 18, while our yellow investor still has over 400,000 that year. Both of these investors had the same average annual return, but the sequence of those returns with the withdrawals is what ruined the purple investor's retirement. Now, before we can know how much this risk really means for you, we first need to know what your overall retirement income strategy is. Decumulation is the most talked about and is basically accumulation in reverse or reverse dollar cost averaging. Stated more plainly, it involves selling your assets to generate income to live on in retirement. This strategy, in its purest form, has the most exposure to sequence of returns, as you are sometimes forced to sell at a loss, and in retirement, your portfolio may never have enough time to recover. Another strategy is one of assets paying you, or a pure income strategy. Whether it is your physical real estate generating rents, or simply a collection of income producing funds and dividend paying stocks, the strategy is to not sell anything, but to have your combined assets printing your monthly paycheck. This strategy is indirectly exposed to sequence of returns, but is only at substantial risk in pure market crashes or prolonged recessions, as generally these assets continue to pay similar rates in more normal bear markets. The most common strategy, however, is a combined strategy, where some amount of income producing assets, an example is a monthly Social Security check, is combined with some amount of selling assets to produce the required income level. Here, we have a more moderate risk exposure. So, our pure decumulator is likely the most at risk, which is why I am personally relying primarily on an income strategy. And although there will have to be selling of assets to address longevity and inflation risks in my own plan, I'd prefer to be in the more low to moderate range of risk. However, even for the pure decumulator, I'm not actually sure you need to be terrified and clamoring to the safety of a financial advisor simply due to sequence of return risk. If history is any guide, it really depends on your situation going into retirement more than the return sequence. I say that because we already have a pretty good solve for sequence risk in retirement, which is the 4% withdrawal rule, which is based on all historical scenarios starting in 1926, including those with really bad initial return sequences, with the research finding that a 50-50 portfolio survived. Regardless of the sequence, and although sequence risk is very real, most of the time we end up with far larger balances than we started with if we stick to a 4% rule throughout retirement. So, you may not need to overly worry about sequence of returns risks if first, you plan on using a 4% or lower withdrawal rate, adjusting for inflation throughout the entirety of retirement. Second, you have a plan for increased spending for known expenses like travel, a new roof, a new HVAC, a new car, etc. Third, you have a plan for increased healthcare spending. Healthcare inflation, which is running at much greater level than the government's CPI reported inflation, and potential end of life care. Like I said, historically, your greater risk using the 4% withdrawal tactic in a decumulation retirement income strategy is underspending rather than running out of money due to your sequence of returns. Now, although we have a pretty reliable solve post retirement, let's talk about where this risk might matter even more, and that is in the 5 to 10 years leading up to retirement. Before retirement, if your strategy again is one of decumulation and you get a bad year or two in the last 5 years, you now might have to either delay retirement until your portfolio recovers or significantly reduce your starting spending, which may not be possible. So, how can we mitigate this risk in the early part of the red zone? First, we could always just keep working and keep investing while the market is depressed. But let's be honest, we don't really want to do that if we're conscious of this risk and picking our retirement year 5 to 10 years out. We probably have a reason that we're doing so that does not include working additional years. Second, we could shift our portfolio allocation to safer assets. So, to go a little bit deeper on these two adjustments, let's look at a possible scenario. Yes, this is cherry picked, like all of the other possible scenarios in every YouTube video that you watch, but it illustrates the point and it's relatively recent. Here is retiree A, who planned to retire in 2023. They have been a lifelong index investor who made one change, transitioning their money to VU when ETFs were created from their original Vanguard S&P 500 index fund. They are proud of the beautifully simple automated dollar cost averaging investment plan and have made it successfully through the dot-com crash and the great financial crisis, barely noticing as they were decades from a possible retirement during those times and were the definition of a disciplined investor. Everything was automated and they simply lived their life. As they got close to retirement, learned about the 4% rule, they decided to shift to a 60/40 portfolio in 2021 after they recovered from the pandemic related crash in 2020, which shook them a little bit more than the previous market declines because they're getting close to retirement. That was their final wake up call to move to safety. Now, because they're an index investor and plan to sell their assets in retirement, primarily because they don't really know that there are other options, they decided to leave 60% of their $1.5 million portfolio in VU, and the other 40% they put into TLT, a popular longer duration treasury bond fund. At 4%, their 1.5 million will start out paying them $60,000 per year, which covers their expenses, and they plan to adjust that amount upward for inflation. In 2022, the year before they want to retire, VU loses over 18%. But the Safe US Treasury Bond Fund, TLT, loses even more at over 29% for a total portfolio loss of just under 23%. Which brings me to my first point in this example. Recent history has proved that bonds, even the safest bonds in the world, US Treasuries, are not a safer asset class if held in a bond fund, and especially if you need to sell shares of that fund for income. After this crash, heading into 2023, their initial retirement year, the portfolio can only generate about $46,200 per year at 4%, and our retiree is now faced with some hard choices. The choice they end up making is to work one more year, despite the bad year of 2022, history and common sense has told them that bonds will counter their stock declines and that 2022 was just an aberration. To find out why that wasn't exactly an aberration, you can learn more about that in this video. Next, we have 2023, and our retiree is still working. And although their portfolio recovers to $1.35 million, dollars, they have also endured higher than recent inflation in both 2022 and 2023. So they actually need to withdraw just over $66,000 per year to have the same purchasing power of their original 60K. And their new portfolio balance can only withstand close to $54,000 per year under the 4% rule. So they're 12K instead of 14K short, but it's still short of what their income plan was originally. Brings me to my second point here is that we often underestimate inflation risk, which is why even the 4% rule barely makes it if we had retired in 1966 versus retiring in 1929. And my final point here is that for a decumulator, I would offer that sequence of return risk prior to retirement can be more damaging than post retirement. The 4% rule is as tested as we have, and with a more diversified portfolio, has even been adjusted upwards recently to 4.7%. But losing your starting assets just prior to your retirement date should be at least, or if not, an even bigger focus, as evidenced not only by the single example I used, but also by this chart. This chart, courtesy of Michael Kitces, shows how a bad last decade compared to a good last decade impacts your available starting amount in retirement, and it's not a feel good story. Our future retiree with a bad last decade has over $1 million less starting out in retirement than one who was lucky enough to have a good last decade. Now, there are trade offs to de risking your portfolio to protect from loss in this final approach. The primary trade off is that opportunity cost of a great or even above average final decade that will probably let you live a carefree retirement. But the downsides of choosing not to de risk, as shown in the chart, can be significant. So it's quite the dilemma and is a very personal decision. Ask yourself, am I fine working another year, two, or even three if things don't play out? And if so, maybe you don't de risk quite as much. If I'm okay doing that, how safe is my job really? If I'm not okay continuing working, am I okay with starting with a lower amount of assets and therefore potentially permanently reducing my lifestyle? Tough questions that only you can answer. A final thing we can do to mitigate against sequence of return risks would be shift our strategy from a decumulation toward income producing assets, even if it's just to help smooth out the earlier part of retirement. So, what's my plan here? In my red zone portfolio, I'm starting to shift ultimately to this allocation, which is not only my strategy for income in retirement, it's also de risking my exposure to sequence of returns risk. First, let's talk about the current 10% bond allocation and the two purposes it's serving. Starting off, it's a laddered allocation that has treasury bonds maturing starting in my retirement year and continues to the earliest Social Security claiming age. So, the first purpose is to de risk my portfolio prior to retirement, as less principal would be lost in the event of a market correction. Even if the quote unquote price of my bonds goes down, since I'm going to let the bond mature, the price it's currently trading at is irrelevant. Second, it's income available in the event of distribution cuts from my income producing assets in the first few years of retirement. And finally, it's paying me along the way, allowing me to keep purchasing more shares of income producing funds, dividend stocks, or making the next bond ladder purchase larger to help mitigate against inflation. Second, I plan to accumulate cash up to about 10% of my portfolio prior to retirement, but I'm still thinking and reconsidering that allocation here as the rate cut cycle has begun and the intermediate to long area of the yield curve is still paying closer to 4%. So I may increase my bond allocation with some of this money instead, but I'll dive a little bit deeper into this cash component in a future episode. Third, a large portion of my portfolio, 40%, is allocated to income producing funds, which I expect to continue paying out regardless of what the prices of assets do on a short time horizon. A few of these assets that I've selected did not cut their dividends in the dot-com crash, great financial crisis, or pandemic periods, but if there are cuts, then that's what the bond ladder is for. Continuing on, 20% of my portfolio is in the dividend growth type of asset, which will also generally continue to pay in bear markets. Finally, is the 20% growth part of my portfolio, which is not really exposed to sequence of returns risk quite yet, even though I'm technically in the red zone, as my current plan does not have me needing to start to sell that portion for likely 15 to 20 years in, unless inflation is far worse than in recent history. So, in summary, sequence of returns risk is not just something that will impact us after retirement. It's something that can absolutely throw off our approach to retirement if we don't have a good plan to mitigate against it. So, how are you thinking about sequence of return risk and what strategies are you using to combat it? Feel free to leave a comment below and let the community know how your plan addresses this particular risk. As part of your mitigation strategy, if you're interested in learning more about income assets, check out this video for assets yielding over 7% from the utility sector. Until then, I'll see you next time right here in the red zone.